Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another edition of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, we cover every angle of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate markets. We'll talk about the national aspects, but we'll also relate them back to the local levels to give you an idea of what you should be paying attention to and how that can affect interest rates, how that can affect you buying or selling a home. And, we're not going to sugarcoat things here on this podcast. We're going to give you the skinny on, specifically what we feel like is going on. We're going to break down the national media, whether it be, articles that have been put out on the internet, whether it's radio, news, TV, whatever it may be. We're going to break those things down so that we can give you the inside scoop on what's actually taking place. And obviously we've had a lot of stuff transpiring over the last couple of years. We've had quantitative easing. We've had mortgage interest rates that had, at one point fell all the way down into the low 3% level, and now they're heading back up. But it's important to understand the underlying factors as to why this is happening and try to position yourself to take advantage, if you're able to take advantage, of the opportunities that are out there. If you'd like to ask any questions regarding anything we covered today, you can always reach out to us via the website at realestate360live.com. That's realestate360live.com. On the right-hand side, there's an Ask a Question button. That's where everybody goes to ask any questions they may have, and we'd be glad to cover anything that you would like to discuss on future episodes. Joining me on our panel today, as he does every week, is Louis Camaro-Sano, who is the former general manager of a major real estate portal. He was a former school teacher and a former attorney. He's often cited in the media as the real estate industry expert. He's been cited in the MSN, Fox Business, MSN, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I can't complain, Louis. We've had a lot going on the last couple of weeks, but it's much of the same as we always say. I did want to touch on a few key things that transpired this week as far as the market. Obviously, we had pretty much a mixed bag of economic news. We had initial weekly jobless claims, which came in higher than expected, and I believe that the prior weeks were revised upward as well, which overall that was very positive for mortgage interest rates. Mortgage interest rates got a little bit better, but they had been peeling, getting worse for, the last week plus. So this was just kind of a correction to kind of bring it back in line to where we were. And then productivity was weaker than expected, which was negative for mortgage rates. We had unit labor costs that were lower than expected, which was positive for mortgage rates. But with all those kind of reports that were out there, obviously the thing that overshadowed everything was basically Janet Yellen's responses to questions that were posed by the Senate Banking Committee yesterday. Mortgage-backed securities, they responded very positive to her dovish comments that obviously she plans on supporting quantitative easing in place and keeping it in place much longer than I think many were expecting. Now, Louis, you and at least I was expecting this to go on forever. But what she said gave further confirmation to exactly what, I felt like was going on here. They have now moved the unemployment target from 6.5% to 5.5% before they start to tighten the Fed fund rate. Further, they said that they'll continue to do the mortgage-backed securities, and even when they do start to taper, they're going to keep the federal fund rate at near zero. Now, my question to you is, Louis, who in the world does it help to keep the Fed fund rate at next to zero other than the banks and the government? Who does that help?
That's it.
That's it. So, we're at a spot now where they're so highly predictable, it's not even funny. They don't have a place to turn. So all that they can do is to continue to extend out these things. They're going to put Janet Yellen in place. She's going to be confirmed. She is going to be the next Fed chairman no matter what at this point. She has a very dovish policy, even more so than Ben Bernanke. It wouldn't be surprising if she goes negative on these interest rates. It wouldn't be surprising if she expands quantitative easing instead of $85 billion to $125 billion, whatever it may be. But with all that's been said, is how this comes back to real estate and mortgage interest rates, barring some sort of major international catastrophe, I would say that mortgage interest rates, since they're going to continue to be the main buyer or the buyer of last and only resort of mortgage-backed securities and treasury bonds, that we're going to have a sustained period of interest rates staying at the levels that they're at. I don't really see them going above, that 4 to 5% range. I think that this is going to be something that's going to continue on, at least while Obama remains in office. Don't be shocked to see that. So, for people that are trying to say, what's going to happen to interest rates? When should I buy or sell my house? I actually think now, with what she said, I can honestly see that when we move back into this spring market, we're going to get a little bit more of an uptick in home prices again, only because I have a feeling that her policies are just that much more aggressive, that this could be the last go-around this spring. What are your thoughts, Louis? What do you think about her comments yesterday and, where we're headed into 2014?
All right, let's discuss what she said yesterday and then how that impacts real estate. She clearly is on the side of QE. She's clearly on the side of continuing it. And as you point out, it's going to carry on and carry on. However, she also wanted to make sure that she said, the program can't go on forever. And, I did a blog post the other day, and I pulled up a 2009 Ben Bernanke interview with, what's the woman, the 60 Minutes, and he said the same thing. It can't go on forever, and at some point we'll stop the money printing. Well, it's 5 years now down the road, and we're still money printing. She said yesterday also, we've got a lot of work to do, which means she's got to crank up the printing press even more. So that's the kind of thing that gets people to gain some confidence that somehow, yes, we're on the right path, we're doing the right thing, just one more fix and then we'll stop. It's just like the addict who tells you, and then you take it on face value, no, I'm going to quit next week. No, right. Sure I am, Monday, and then, I promise you, that's what's going to happen. And, they ate this stuff up. And even, John Hilton Rath at the Wall Street Journal, he grabbed onto that comment and said, this program can't go on forever, comment from Janet Yellen, is a message for people who are using the term QE eternity and QE infinity.
Yeah.
Yeah. Okay, Ryan, so you're wrong now. You see, because you've been predicting that they're not going to stop QE, and they haven't stopped it. But they said they might. So therefore, Ryan, you have no credibility. The Fed has all the credibility in the world. And before we go on to real estate, what I want to mention, Ryan, is the amount of credibility that the Fed has exceeds what the president has, what Congress has. It's unbelievable because there was a little drama going on yesterday. You had Yellen testifying, and then you had President Obama, who has an enormous ego and has every reason to have one because he's president of the United States. But he's up there. He's saying he's sorry. He's saying, I fumbled. I made a mistake. He's basically saying, I didn't know what was going on. I didn't know what I was doing. But I'm going to try better. I'm going to try harder. I'm going to try to fix this. You'll never hear the Fed or any of these Federal Reserve people get up there and say, we made a mistake. They say, we got it under control. If there's ever inflation, we can nip it in the bud 100%. They never admit an error. She sat there, and she basically said she knows what to do. They're on the right track. This hasn't been a mistake. Quantitative easing works, and we need to do more of it. And everyone's like, oh, okay, well, she's going to be the Federal Reserve Chair. You'll never see her stand up there and say, wow, we got our clocks cleaned. We had a Lehman happened on our watch. We had the greatest recession. We had a housing bubble we didn't see coming. They don't say any of that stuff. They don't apologize. They are totally unaccountable. Okay, so I was just an observation. I'm watching Yellen, and I'm thinking, who is she? She's read a few books on economics. She spent her entire year in academia and on the Fed, and she's got all the confidence in the world that she knows how the entire economy works. And meanwhile, you got President Obama. He's admitting he doesn't know how a website works.
Yep.
Which is a lot simpler to figure out than the entire economy, but yet she's got all the answers.
Yep.
Anyway, so now, as to real estate, you mentioned home prices and what might happen as a result, because if you do have these ultra-dovish QE monetary policy, low interest rate environment, you would expect that home prices could rise. I disagree with the rising of the home prices only because we've seen lately the affordability of homes has it's kind of at one of its lowest levels in the last 10 years. So home prices, it's difficult for them to rise if there isn't an underlying economy. And I make the contrast between how QE does help create asset bubbles. But the difference between the stock market and the housing market is stocks can go up irrespective of what the price is. A $10 stock can go to $40 and go to $100. It really never becomes unaffordable. It just becomes overpriced. What I'm concerned about in the housing market is a lot of the money that's available through these cheap and low interest rates will start to leave the housing market and will start to go back into other speculative items like fine art, fine wine, stocks, and so on. But housing won't have that same attraction because you can only push home prices up so high. And I think that's where we're going to get hit with home affordability. And so the real estate market will do well because of the low interest rates. And people who can have access to credit will be able to take advantage of low interest rates. But they're really not going to have to pay that much more than they're paying now. I don't expect the home prices to continue to rise, only because the employment and the wages aren't rising. What are your thoughts on that? I take it by your market as opposed. I'm just looking at it nationally. Yeah. I don't think the economy can support higher home prices, but it clearly, with excess QE liquidity, can support higher stock prices.
Yeah, so, in the D.C. metro area, specifically like Northern Virginia, and then you've got certain areas in Maryland and D.C., obviously the employment situation is a lot better than other places in the country. But the biggest thing that I pay attention to is the inventory. And there's still a pretty major inventory shortage, especially in certain price ranges. So what the reason why I'm saying if this continues, I have literally, probably 30, 40 people that are sitting on the sideline just saying, hey, coming through this winter, they've gained just a lot of equity position through this whole year. Now, I don't really see that there's going to be much of a pullback in prices going through the winter. I just think they're going to stay pretty constant and stable. Coming back out on the spring side, they're going to be able to put their house on the market. There's going to be, probably, I would say in the spring, there's going to be a decent amount of buyers because these people are I would say they're the last man standing as far as they're the ones that said, I'm going to hope for interest rates to potentially come back down, but they don't want to make a move through the winter. They'll make a move in the spring. And I've been watching, just locally, home prices. Every time a house goes up, there's another house that's going up $5,000 higher. And I haven't really seen problems with appraisal. So that's kind of a scary thing when, you're starting to jump in $5,000 increments, Louis. You know what I mean? Just because that's typically difficult to do. It's typically difficult to just keep jumping $5,000 increments. But when I'm watching, townhouses that started off at $250, and then now they're at $300 and still rising, even into November. I don't know. I just honestly feel like that they're so conscious of keeping people happy and happy-go-lucky about just the overall market. And the real estate's just such a big component because people are so emotionally tied to their home. And they want to keep values moving up. Now, granted, it might not be at the same pace that it was this past year because we're probably not going to see interest rates back into that 3% level. But with that being said, I still think that there is going to be some appreciation in most metropolitan areas. I don't really see it slowing down. I can see it slowing down a little bit because obviously, yes, it's going to be more difficult to afford higher price homes. And
slightly higher interest rates with no wage increase. It's a tougher road to head up.
But you know what, though? What I'm seeing as a pretty common theme is that there's still programs out there. There's still 100% financing from credit unions that go up to $625,000, zero money down, zero mortgage insurance. There's still adjustable rate mortgages that you can get down in the 3% level. So, what happens is, and I've seen this the last time, when house prices start to rise and people still have the necessity to move because they need more space, they find alternate loan programs to be able to capitalize on those, right?
That's what happens towards the end. That's correct. And then finally that becomes unaffordable.
Exactly. So what I see happening is that, fixed rates move up a little bit more, but we're going to have adjustable rates that are going to stay low. And now we have basically Yellen saying that, hey, look, you know what, we're going to keep the Fed fund rate or short-term rates low. Typically, if you pay attention to LIBOR and Treasury and all the other things, what do they typically do when the Fed fund rate stays low, right? They stay low as well,
right.
Okay? So that means we're going to have short-term rates, adjustable rate mortgages, 3, 5, 7-year ARMs that are going to stay really low. So even if and I think that this is what I was thinking about this the other day, and I was like, you know what, that makes sense if Yellen can come out and say, you know, even when we start to pull back our QE, that we'll still keep that fund rate low. And they set a target rate for unemployment of 5.5% because they know that that's unattainable, so that they'll be able to drag this out forever, and they'll be able to keep short-term interest rates as far as adjustable rate low.
Well, they can keep those rates low. That's correct. They can set them low. But the question is whether the market will respect and stay close to those benchmarks that they set.
Well, you know what? I don't think they have a choice but to do that. I mean, they're so dependent upon, you know, following the Fed and exactly what they're doing that the market is following them almost to a T. I mean, even when we have a fantastic economic report, interest rates aren't shooting out like, you know, a whole percent. They're shooting out about 1/4 to 3/8, and then about as soon as that happens, then we have Yellen, she has her committee, and then boom, they're right back to where they were. And this has been the common theme for over a year now, right? Every time we get this big, you know, spike, there's somebody else that brings them back right back in line, and that somebody is always the Fed. It's always the Fed.
Oh, it's always them talking one way or another.
Absolutely. So,
but did you hear her say that the Fed will not be held prisoner by the markets? And I thought of you when she said that, because I think it's the other way around. You always say the markets are being held prisoner by the Fed.
Absolutely.
You're making the point that the markets follow the Fed no matter what. Whether it makes sense economically, they know that the only game in town is the Fed. And they have to follow the cues of not just what the Fed does, but what they say.
Yep.
And when they talk to market, when they come out there and they say, we're going to taper, and you know it's 100% nonsense, they still price the bonds as if the Fed is going to taper. And then the market goes up. So you're right that basically they have all this credibility, and they're able to control interest rates in the range, like you say. But it's ironic that she's up there saying we won't be held hostage to the stock market when it's entirely the other way around.
Absolutely. And, you know, what's interesting, I sent you that article yesterday by Andrew Huszar, The Confessions of a Quantitative Easer, that was in the Wall Street Journal.
Right.
So Andrew Huszar was a former Federal Reserve official that was responsible for executing quantitative easing, the bond buying experiment with buying mortgage-backed securities and treasuries. And within this article, it is very telling that he basically comes out and says that this is not helping anybody but big banks. It's not helping anybody but the guys that have all the money to begin with. And that, you know, he actually got out of the private market, went to work for the Fed, and at the end of the day, you know, was kind of disgusted about what was going on there. And, you know, at the end of the day, it wasn't working. It wasn't accomplishing anything.
But it's still going on, and people are shaking their heads saying, yes, we have work to do. It has to continue. But we're going to stop one day.
Right. But, I mean, when you have somebody that's within the Fed coming out and saying this, and of course this news gets buried. How many people are talking about this on mainstream media right now?
Oh, and then, of course, he doesn't know what he's talking about. He was just a ministerial employee. He was just buying the bond. You know, they'll discredit him. He doesn't know what he's talking about because, of course, the 12 wise men and women at the Fed understand how to control an entire economy.
Yeah, I mean,
no task is too great for them. And, you know, if people believe that, it's just like the Wizard of Oz.
Yep.
When they believed the Wizard of Oz, they all thought they were going there, and they were going to get a brain, a heart, and courage. Until they realized they weren't.
It was interesting because he went on to cite even Mohammed El-Arian and PIMCO investment firms suggested the Fed may have it spent over $4 trillion for a total return of as little as 0.25% of GDP, which equates to about a $40 billion bump in economic output for the U.S.
Correct.
And
you take that away, and there is no GDP growth. There's negative GDP growth.
Exactly.
You'd be better off handing out money on a Keynesian stimulus program, handing everyone in the country $20,000, $30,000, and have them go spend it.
I was about to say the same thing. So if they really wanted to accomplish things, the Fed would just set up basically where, they just hand out money to private individuals, to small business, give them the money. And then you
have navigators on, Obamacare navigators handing out money.
Yep.
No, you're right, Ryan. The money just goes to the banks.
It does.
But if you think about it, the shareholders of the banks. So when they have a meeting, the Fed has a meeting. It's basically a meeting of the shareholders, right? Mm-hmm. And they say, here's what we're going to do. They're not going to say, okay, we're going to give money to somebody else. They're going to give it to themselves. Well, they have the ability to print. If you think about it, they have the ability to issue currency. So they issue it to themselves. That's fraud.
It is. And,
I mean, they print up money and they give it to the banks that are their shareholders.
They're not only printing it up and taking it, but then they're leveraging it 10 to 1. You know what I mean? So, like, not only are they printing this money and giving themselves all this money, essentially they're not paying any interest on that money and then investing it in the market to make money and then lending it out 10 times and leveraging it. I mean, it's unbelievable. I mean,
and you know what they're going to do, Ryan? They're going to do it until unemployment comes down. Well, employment's not going to come down because of any money they print and give to themselves. That has nothing to do with it.
Yeah, it's not like these banks are turning around and taking the money and creating jobs with it. You know,
they're
not doing.
In fact, they're cutting back.
Anything, but they're
all their mortgage arms are losing jobs.
Well, if you look, what is it, $2,000-3,000 or 2,000 or 3,000 workers every month almost is
right.
Seems like what the norm is because the mortgage
QE doesn't create jobs. QE creates free capital for the banks, and it also creates free promises for politicians so that they don't have to cut spending, because our deficit spending is funded 70-80% by the issuance of bonds during QE purchases. I mean, those $45 billion a month U.S. Treasuries, those are freshly minted based on spending that the U.S. government is doing, based on promises that politicians have made to its constituencies in the forms of either to the industrial military complex, to the farm subsidy, to welfare, to Social Security, whatever it is, whatever promise has been made that needs to be financed is not being financed through taxes. That only covers a certain amount. The deficit comes from issuing bonds, and the Fed prints up money and buys them. So the government is in cahoots with the Fed and allows the Fed to print money, give it to itself, and to print money and buy government bonds from it. And then take a commission for being, the primary dealers, their shareholder banks being the primary dealers in the transaction.
Yeah. And
no one's upset about this. Everybody thinks, it's kind of working, and they did save us from, a big meltdown in 2008, not realizing they caused the meltdown in 2008.
Absolutely. And, Mark Huszar in that same article, it basically said the Fed is at the center of all the dysfunction. Case in point is allowed QE to become Wall Street's new too-big-to-fail policy. Right. And I'm going to read this little blurb right out of the article. It says, unless you're Wall Street, having racked up hundreds of billions of dollars in opaque Fed subsidies, U.S. banks have seen their collective stock price triple since March 2009. The biggest ones have become more of a cartel. 0.2% of them now control more than 70% of the U.S. bank assets. 0.2 control 70% of the assets. And he goes on to say for the rest of America, good luck. So, I mean...
Ryan, if you and I wanted to start at a bank and we had sound lending principles, we had some capital, we wouldn't get off the ground. Just the regulatory compliance would drive us nuts. Well, what did we talk about the other week? J.P. Morgan spending billions of dollars in paying fines and legal compliance.
Yep.
That's the price they have to pay to keep everybody out, because you couldn't even open your doors as a bank today. When's the last time you heard of a new bank opening?
You don't.
You can't.
Yeah, there's an extreme barrier for entry. You know what I mean? They would make the qualification something absurd, and then not only that, they have such, like the local banks, they have like really strict lending restrictions. You know what I mean? So
how can they make any money if they can't lend money?
Right. I mean, you're not going to see them growing all over the country. I mean, I know a bunch of local banks that I do business with. Like, if you're trying to get a mortgage or some type of commercial loan or whatever it may be, they can't go outside of their designated area. So let's just say that it's Northern Virginia. If you have something that's in Southern Virginia or in Maryland, they'll say, no, we can't do that. That's outside of our reach. You know what I mean? So it's not like that they can just, come in and lend money like a Bank of America or any of those. Now, there are more aggressive products. They have them, but you have to fall within their area. So yeah, you can't just start some bank and grow it to become a J.P. Morgan, a Citi, Bank of America. It's not going to happen. These are the big boys, and they're
people are conditioned to think, well, that's a good thing. Of course not. I remember during the presidential campaign, maybe you remember this remark, when Romney said something like, well, we just can't have people starting banks out of their garages. Well, why not? I mean,
right. What's wrong with that?
What is the problem with somebody trying to create a product or service from the ground up? Is it only tech companies that are allowed to work out of a garage, that somehow lending money? You know, lending money used to be done right out in the open. That's where the name bank comes from, the banchieri that they had in Venice. The Jewish bankers would sit there on a bench and lend the money directly off the table. And it's not really some type of complicated transaction that requires some special regulation and sterility. Right. It can be done out of a garage.
Yep. Yeah, but they don't want that, and all the other regulations.
Of course not.
And all the other regulations that are getting ready to take effect, like the qualified residential mortgage rules, and all these rules. Who are they set to benefit? The big banks, right? Because they're trying to prevent any sort of private investment from coming in. So it's going to be interesting to see, they were trying to stall out this qualified residential mortgage rule. So I don't know if it's going to, get pushed back a year or delayed a year, Louis. But if that gets implemented, that could have a pretty substantial effect on the overall real estate market as well. Because, if Fannie and Freddie are only going to buy certain mortgages, and they're pretty much the lender of only resort because they basically buy up 90% of everything that's out there. And we don't really have any private money. Now, there is the credit unions. I always come back to the credit unions, and I talk about this quite often because I think for people out there that are actually looking for mortgages right now, and you've been unsuccessful with going to, some sort of local lender, whether Bank of America, Wells Fargo, whoever it may be, you're unsuccessful, it is always good to turn to a local credit union and go there just because they do have different criteria. They do portfolio loans. I actually had a client not too long ago, Louis, that had a short sale that she had just come out of. It hadn't even been 2 years, which most of the time the rule is about 3 years. It only been about a year and a half. And they said, you know what, if you'll put 20% down, since you're a member of our bank or whatever, we'll give you a loan. So they gave her like a 7-year arm at like 3% with 20% down. So nobody else would touch her. Nobody else would, but they would. So I think that, and the media is not, mainstream media is not going to tell you that there's these other options out there. And then
they're not aware of them, though, Brian. Even if they wouldn't tell you if they knew about them, but they're hard to come up with.
Credit unions don't have very, very, expensive marketing budgets either. You know what I mean? They
right.
can't spend as much money as the big guys can to push these products out there. So that's why it's kind of my job to let people know that there are multiple options. And not to just give up right away, because a lot of the time that's what happens. It can be very frustrating when you're only looking at, hey, I can only get a conventional mortgage and put 10 or 15, 20% down, and they don't know where else to turn.
Well, Ryan, you're highlighting what we've become is everything is one size fits all, too big to fail, national health care. Things aren't being done at the local level where you have to scout out and find the local provider who might give you a good deal.
Right.
We're conditioned to think, well, you can go to Bank of America or Wells Fargo. And you've got these big national choices. Even real estate. People get their real estate information from the mainstream media, which is almost inevitably, even though they try sometimes to do local, it's almost inevitably some type of national information provision that they give you, that foreclosures are down, foreclosures are up. Where? And they just list that, across the country they are. And then you have to dig deeper and find out in which states and in which cities and which MSAs and so on.
Well, the comment that always gets me is when somebody says, well, yeah, I'm just going to get my mortgage from my bank. I've had my account there forever. I've had my money in there forever. So I feel like, they'll give me the best deal. Really? Because how much interest have they been paying you on your money in the last 10 years? Right? like they've been doing you some sort of service. They're lending your money out 10 times what you put in there. Okay, they're making money hand over fist. I don't to think that you think they're going to get a good deal just because you're a customer of theirs. It doesn't work that way.
Well, first of all, you're not a customer of theirs. They're a customer of yours. You're the one lending them the money when you make a quote unquote deposit.
Yeah, and everybody's been conditioned that it's like a necessity to have a bank, right? Because of being able to pay your bills, and I guess it would be more of a pain in the butt to go and cash your check every month, keep your cash on hand, and pay your bills with money orders and everything else, right?
But Ryan, considering what you point out, it'd be one thing if all they did was held your cash for you. Then you could understand why if you went in there and you gave them $1,000, that you might not get $1,000 back because they're going to hold it, they're going to insure it, and it's there when you want it. But when you give them $1,000, they lend out $10,000 and make money.
Yep.
Now, what Janet Yellen is about, she's about negative interest rates. Not because she wants the depositor to lose money. She wants the depositor to spend that money. She wants the depositor to put money into buying stuff, buying assets, because that's how she thinks you stimulate the economy. That's how you get inflation. When you put the savings rate below zero, where it actually costs you money not to spend it, you spend it, which is crazy because then people have no money whatsoever. They have no savings, and they go out and they buy stuff that depreciates the minute they buy it. And who does that enrich? It enriches the big producers of goods, and it enriches people who borrow money by speculating because interest rates are basically free. They're zero. And that's what she wants. I mean, she did not get one question on negative interest rates that I heard. You had Alan Greenspan with low interest rates, and everybody now says that's what caused the last housing bubble. Then you got Ben Bernanke, brought him down to zero, and we're still stuck in this recession. And now she wants to take them. She's talking about negative interest rates, which is basically a de facto Cyprus situation where you put your money in the bank, you come back, and you get some of it back. You don't get all of it back.
Right, you put in $1 and you get 90 cents back.
Now, that would be okay. Like if you have gold storage, right? You put $1,000, couple of coins in there, it's going to cost you for them to hold on to it. You'll get your 2 coins back. It's going to cost you $100 or $2 a year.
Right.
That's an acceptable bailment transaction.
Right.
But now when you put money in and then they loan your gold coins out, they sell them, and they make $10,000 off your gold coins. And then when you come back, they say you can only have one of them. That's crazy, but that's exactly what the banking system is right now. Yeah, and it's gone from paying interest, low interest, no interest, and now they want to make you pay to have money in the bank just about.
Yeah, well, it's amazing to me that, with a business, right, a business that has $50,000 in their checking account, they only have $50,000 to work with. They go to a local bank. They try to get a business loan to expand their business, to buy more product, just to be able to grow. And they go to the bank, and the bank's basically like, well, hey, you don't really show enough income on your tax returns, therefore we can't lend you this money, even though you've got $50,000 in assets with that bank. But for a bank that has $50,000, okay, we can turn around and basically give out $500,000
because they have reserves.
Exactly, they've got reserves. I mean, it is unbelievable that.
It's funny. They don't really even have $50,000 because if you come in to get that $50,000, you won't get it. Right. They'll give you a hard time to get it.
They'll tell you need to give them at least 2 weeks' notice.
Right.
You know what I mean? They won't just come out and even when I go to one of my local banks, they only keep I just heard them, and I probably wasn't even supposed to know this, but I just heard them talking to each other that they only keep like 10 to 20 grand cash in the bank itself. Right? So
they treat you like you're a criminal when you go to get your money out.
Well, yeah. What are you going to do with that money?
Seriously, I've heard that they've asked those questions. What are you going to do with that money? Now, presumably they're claiming they're asking that because they might have some investment options for you. But no, they're actually, what are you going to do with that? Like somehow they need to know.
Right, and then because of the whole rule, when you deposit over 10 grand, they have to be reported and things like that. So they're basically trying to figure out if you're some sort of, guy that's a scammer or something like that, or trying to reach around IRS rules and regulations. But
well, there was a story that I saw, Ryan, where there was a local business. I think it was a bakery, but it was some type of local family business. And for a year, he was making $9,900 deposits with his bank. And he'd accumulated, I don't know, $150,000 in his bank account for the business. And one morning he went to look at his bank account, and it was all gone. The IRS had taken the money out of its bank account. And they claimed, no reason, there were suspicious transactions. Now, the suspicious transaction was, they said, now they're only supposed to pick up, over $10,000 they were supposed to be reported. So he didn't report anything because they were $9,900. So they assumed that, of course, if they're under $10,000, then therefore he must be doing something wrong, so we're going to take his money first and maybe ask questions later. Well, it turns out what the guy was doing was he had insurance that allowed him to insure his cash in his office up to $10,000. So he would only get that amount of money and bring it to the bank and make sure that it was under $10,000. He wasn't trying to do anything untoward. But, of course, they came in, took his money, and he had to spend a protracted legal battle to get it back. I mean, it's easy to go after the little people like that, and then you look at what they do on Wall Street and the big banks, and you say, well, this guy's a baker. He's not doing anything wrong. You should be praising him. He's probably got 5 employees, including the 2 kids his own kids, probably. I know it was a grocery store. It wasn't a bakery.
Yeah, I mean it's crazy. But we're not going after the banks that are leveraging our money to go and invest in whatever the hell they want to go invest in, right? So it's this ridiculous double standard that's going on, and it's been going on forever. And if they really wanted to fix things, guess what, Louis? They could actually say, guess what, banks, you're not allowed to leverage that money. You take $1 in, you can lend $1 out. How would that change things, right?
Well, sure. Or you basically can allow fractional reserve banking, but it doesn't. It would have to be some type of niche product.
Right.
In other words, I wouldn't outlaw that type of banking. If people want to do that, and then banks would compete to say, well, our fractional reserve banking is because we loan this way or that way, we have better credit standards, and we're able to pay, and they'd have to pay a higher rate of interest for the risk you take. Think about it. You put money in the bank, and you're basically handing it over with no assurances whatsoever. That money becomes property of the bank, that you'll ever get it back. The only reason you even think you're going to get it back is because of the FDIC insurance, which is crazy because there's hardly any money behind the FDIC. No. So basically, if the banks really do screw up, you won't get your money. There's not enough money in the FDIC funds to cover less than 0.1% of 1% of all the deposits. Right. So it's a confidence game. You're just put in there and you think it's a bank. It's like money in the bank. We've learned that expression, right?
Yep.
You knew what they did with your money. You wouldn't use that expression. They used to say good as gold. They don't say that anymore. They say money in the bank.
And the funny thing is what happens when a bank goes out of business. The FDIC, they basically take them over, and then they find a bigger bank to come and take over all the assets, right? And that's what happens. They just go from one bank to the next. They don't just disappear because that's the way that the FDIC gets around having to really do anything. They just find another bank.
And where does the FDIC get the money from anyway? We've already paid tax money. Right.
Well, the banks have to pay in an insurance, right? But that can't possibly cover the amount of assets and cash that's out there. It's just no way.
But what's interesting is they're not really assets because if they can be reproduced, and they're fungible with just a keystroke, it really doesn't matter because, like you said, why do they even go through this farce with the debt ceiling? Why don't they just have the Fed print up whatever the difference is?
Right.
Because that's how easy it is, and that's how they have disrespected the rules of money. The fact that a central bank buys U.S. Treasuries and mortgage-backed securities from private banks by printing money is absurd. Even if you believe in central banks, that's not a role of a central bank. A central bank is supposed to be a place where they've got large reserves, and they are the bank of last resort. If all the other banks start to fail, they go and bail them out. What they're not supposed to do is fund the government or buy bad assets from banks, under central banking, banks would fail. They just would say, we don't have the money. You screwed up, and there's really not much we can do about that. And if the government is short of money on deficit spending, central bank's not supposed to print money and buy U.S. treasuries. It's not supposed to buy bad mortgage loans. So I'm not a fan of central banks, but I can understand the concept of a central bank if it didn't buy through money printed out of thin air anything it wanted to support the stock market, to support the government.
Yeah. And it's amazing to me, Louis. So if we had some sort of normal market conditions and what you're a stockbroker, some sort of trader, and you're looking at what Yellen says, you would say, "You've got to be kidding me! You can't do this. This is terrible."
Do it more. She's going to do it more.
Right. The market should sell off. And the fact that when they do things like this, the stock market gets better. It keeps going up and up and up. It's against everything that you would see in a free market.
Well, Brian, she's saying there are no bubbles. Okay, let's define what a bubble is. A bubble is when prices rise far beyond what any rational person who wasn't in a mania would pay for something. And not only any rational person, everybody's buying it. Okay.
Right.
Well, that's what the stock market is right now, because if you did not have QE, those companies, their stock prices would not be as high as they are. And she says there's not a bubble. Okay, then pull the QE off. And she says, well, we can't pull the QE off because the economy's not doing well. Well, if the economy's not doing well, why is the stock market hitting all-time highs when the economy's near an all-time low? It's because of QE. So she can sit there and say, we don't have a bubble in real estate. She said that too. We don't have a bubble in the stock market. The reason real estate is in a bubble is not based on prices, because the only reason people are able to buy these houses today, whether you're an investor to make it attractive or a regular person, is because of the low interest rates. So real estate is in a bubble. Forget the pricing, because the only reason people are able to buy these houses, the only reason more people aren't underwater than are right now, is because of the QE that's helped lift the home prices. So that in itself is a bubble, because these home prices went down for a reason. People couldn't afford them. They couldn't make their payments. The economy was bad. There weren't enough jobs. The reason the housing market came back was 50% cash buyers, spurred on by QE, and other people who were able to take advantage of the low rates bought the houses, putting the prices up. Without the QE, you wouldn't have this. So that, by definition, is a bubble. These are prices that you otherwise would not have in a free market. Same with the stock market. So she can say there's no bubble based on the assumption that QE is just basically a permanent fixture of the economy. So if you always have QE, well, these prices are normal. You take QE away, and the whole thing collapses. Bubble popped.
Well, guess what, Louis? I'm convinced that this is a permanent fixture of the economy, because there have been many that have said that if there wasn't QE, that we have Armageddon, right? We have basically World War III. Where we're at right now and how dependent upon the markets are on the Fed and everything else, I kind of think that now. I think that they know that this is just a matter of time before World War III happens, right?
When you say World War III, you're doing economic World War III, you're just talking about physical?
Well, just international disaster, right? Because...
everybody's dependent on the United States, the dollar, and what fiscal and monetary policy are.
Yeah, but it would also crush the economy here. I mean, and the thing is that, if all the money that was printed got released into circulation, we would have hyperinflation, right? So,
absolutely.
And this is like the whole thing, the mindset behind the Fed too. It's kind of like, well, if they just lend it to the big banks and it never trickles down into the economy, then we're not going to see that inflation, right? We're not going to have these high levels of inflation, so they can keep saying to themselves, "Hey, look, inflation's still in check. I can keep printing this money." Well, it's not making it right. It's not making it to the hands of the people that need it. It's just making the rich richer. Who cares? The economy.
Right, but by the time it gets to the rest of the people, there will be hyperinflation.
Right, and so how long is it going to take? I mean, and we talk about this almost every week, but it's like, okay, so now Yellen's in, Obama's got about 2 more years left, so we're at least getting through 2 more years. How probably, most likely, unless, like I said, there's some sort of international catastrophe or something that takes place to throw things off course. The chances of us of us losing our reserve currency status is slim to none because everybody's so dependent upon us.
Well, you know what might happen, an alternative, Ryan? I've been thinking about this, is if there doesn't have to be this one-day Armageddon moment, currency collapse, and so on, if quietly behind the scenes, and it doesn't have to be now China becomes a reserve currency, it may be that things slowly drift away from the dollar. I see that happening already. You see countries making arrangements to make payments in other currencies. I mean, already the international trade is down to 60-70% in dollars. It used to be closer to 90%. And I think eventually also the interest rates will rise irrespective of what the Fed does, and that will probably cause a panic at the Fed, and they'll probably print more money, and they'll bring the rates down a little more. But at some point, they will get into a point where they lose control of the interest rates. The rates will go up irrespective, but maybe by that time there'll be enough liquidity in the system outside of the dollar that the entire financial system won't collapse. I think it'd be a good thing for some of these banks to fail. It'd be a good thing for, you don't know what will happen, and that's the disadvantage of economics, is you can't predict what's going to happen, and therefore, if you can show what is happening through your monetary policy, just like with fiscal policy, when you can build a dam, you can say, see, I built the dam and X number of jobs are created. It's hard to argue that if you didn't do that, something else better would have happened. But I think that actually what's going to happen is that when you take the central planners out of the equation, you take the manipulation out, and you think about what we had in the 1800s, 1900s, when you didn't have all this manipulation, that's when the United States was firing on all cylinders. You had the invention of electricity, you had skyscrapers being built. Things happened very quickly because of a free market. And now they're trying to control the free market.
Right.
And because the people that are already rich, they want to stay rich and they want to get even richer. And I think that's eventually going to crack because they're trying to control a game where they're not producing anything. And also because they're not producing anything, there's less and less for them to be able to hand out. And if you look at the poverty rate in the United States, you look at the food stamps, yeah, you can hand that stuff out to people. That really doesn't make them happy. It just keeps them from rioting. But it's not giving them an opportunity. And you think that's what people used to come to the United States for, an opportunity. They don't come here. But people are leaving the United States. I don't know if you saw the recent numbers where people are renouncing their citizenship just because they're better off somewhere else. They just don't see the advantage. And that's really a disgrace because that should be one of the most valuable things that the United States offers is an opportunity.
Right.
And, if they try to force the dream of home ownership, and look what's happened, Ryan, home ownership rates are lower now than when the recession started. Well, that should tell you something. That's not a housing recovery. If there's more people in poverty, houses are more unaffordable, and fewer people own them, how is this Fed policy working if you're heading in the wrong direction and she says she wants to do more of it?
Right, and you're keeping interest rates extremely low, and people still can't take advantage of them other than big banks, hedge funds, and the rich.
Right.
I mean, it's right in front of your face. That's what just blows my mind when the traders in Wall Street they know all this information, right? But they're just willing to say, you know what, I don't even care about any of that. As long as the Fed says QE, we're golden, right?
Well, because they are golden. And if you think about it, it's the tragedy of the commons. People know what they're doing may harm the greater good, but they're making money themselves. If they don't make money, making a statement by not taking the money isn't going to change anything.
Right.
If they're opening up the pasture and saying you can graze your cattle here for free rather than waste your own resources, bring them to the field. Until somebody decides that field shouldn't be wide open, it's not going to be managed properly. And people are just going to take advantage of it to everyone else's detriment.
Well, I go back to when Bernanke, took Fed chair spot. He thought that he had everything under control, and remember that, and basically he had this all figured out.
Yeah. And he started taper talk back last year. It would happen this year. It was going to happen this year. Well, it didn't. He's going to leave. And he spent 5 years saying he was going to rein in the stimulus.
And remember, I said exactly this. I said, look, he's going to. Nothing was going to happen on his dime, right?
Nope.
So she gets to come in and she gets to have her moment of glory where she gets to state what her stance is going to be, what she's going to do. Now she said it. She said it. So 5 years
she's got to
from
implement
now,
it.
right? 5 years from now, what do you think? What do you think the deal's going to be? You know what I mean? Or it's to me. See, like I can't figure out timelines, and that's the hardest thing. Like you don't know the timeline, how long things can go on for. But I'm convinced that this can go on for a long time.
Ryan,
long
4 years ago when we were having our discussions, we were saying by 2012, 13 at the latest, this whole thing would crack.
Right.
And they've just increased it.
Based upon fundamentals, it should have.
Right.
You know, but those fundamentals don't matter, and the only thing that matters is what they say. So, and they could, you know, as long as they say the sky isn't falling, it's not falling, right?
Absolutely. If she were to have said, yeah, you know, stock prices are high, real estate prices are artificially high because we're buying $85 billion a month. So what I plan on doing is in January when I take the chairmanship, I'm going to stop these plans and we'll see what happens. Well, the whole thing would collapse.
Yeah.
But that in and of itself should tell you if there's two options, and one of the options would lead to a disaster, and the other option is kick the can down the road, you know they're going to kick the can down the road, but that should also tell you that things aren't, when she even said the economy, just like Bernanke, the economy is weak, need low interest rates, she says we're not there yet. When are you going to be there? Because if you had the magic fix, you have a patient who's sick for 5 months and he's on 5 years and he's on life support. You can't say he's recovering. He's on life support, and you keep jolting him and doing stuff. At some point, you have to admit, I got to take him off life support and see if he can make it, or I can just admit he's on life support, and what are we going to do here? Or you can't say he's on life support and he's recovering.
Or they can just keep changing the metrics for what they're looking at. You know what I mean?
He moved his fingernail, his pulse changed. You know, they keep putting it's a good analogy. That's what that data is that we get every month. You know, the initial claims are up. Yep. Oh, well, that means we should keep them there. Oh, we should increase the dosage. Maybe we'll reduce the dosage, and that'll give us hope that he's getting better.
Yeah. Okay. Hold on 1 second. Hold on 1 second though now, because it looks like our output is up just a bit, right? So now we have to reverse course now.
No, but you see earlier, Ryan, in the day, you had Empire Manufacturing was down. You're just jostling the patient back and forth on the emergency room table for 5 years.
Yeah, and it's no longer kicking the can down the road, Louis. It's punting the can down the road, right? Like we're not just kicking it in front of us; we're punting it so far away.
It's kicking it out of the stadium and pretending you're still playing a game.
We can't even find the can right now.
Exactly.
You know,
look, all this stuff when it first started it was an exit strategy. You would come in, come out. It's a temporary measure. Even Keynes talks about that. You know, that in bad times the government picks up the slack, does a little stimulus. That in good times it pulls back and allows, you know, surpluses to be there. This is just stimulus 24/7, 365 days a year, decades at a time now.
Yeah. The only thing that I wish, Louis, is I wish I was the one that was being loaned millions and trillions of dollars, and I could leverage it out 10 times that. You know what I mean?
Not just that. Then, with the profits you make, by stocks, by derivatives, by real estate, you can't lose.
You can't. I mean, once you have this type of money at your disposal and you're paying nothing for it, I mean, how could you not become ultra rich? It's impossible not to. Yet the people that are getting mortgages and having to pay interest rates, they're struggling just to get a loan at 4 or 5%, right? They get it at 0. And Yellen,
but they're being told we're in a recovery, so keep it up.
Yeah, there's no such thing as a recovery. What's going on right here? Just masterful manipulation, and don't expect, guys, for much to change between now and in the next 2 or 3 years. Right.
The only thing that's going to change is, Ryan, as you say, there'll have to be either a huge event, and you never know what those are. Those are called black swans.
Yep.
Or we'll just slowly, before we like in the boiled frog syndrome, where you try to put a frog in boiling water, he won't jump in. Because he's cold-blooded, you put him in water and you steadily raise the temperature. his body just adjusts to the temperature. Before you know it, he's a cooked frog. I mean, that could happen to us in the United States. We just, it'll be a big surprise to everyone here that we've lost our status as some kind of economic superpower. When you don't have a lot of people working, when the labor participation rate is 62%, you're not an economic superpower. You can't expect half the population to be on benefits and the other half to be kind of working and getting benefits and expect to retain your status as some type of economic superpower because you have the Fed and the world reserve currency. At some point, someone's always trying to knock off the champ.
Yep.
And the United States isn't really training very well right now.
Not at all. Not at all.
But if you're like you and me, Ryan, what do? You if you can take advantage of the low rates,
you do that. I mean, anything that you can possibly take advantage of, is whether it's buying real estate if you're able to. I mean, you have to figure out if you qualify, if you're able to do it. That's all you can do. I mean, you're only in control of what you can and can't do. And I mean, obviously we're not all the millionaires and the big banks here, so that's about it. I mean, take advantage of low interest rates if you can. Unfortunately,
the better thing is to, instead of people becoming entrepreneurs and taking advantage of low rates, you just tell people to save money, but they can't. Work hard and save money. You can't do that. If you don't have a job, you can't work hard. If you have a job, you can't save money because where are you going to save it?
I know. Well, we're coming up on the end of the show, Louis, but I want to thank you again for coming on. We'll be back again next week to dissect what transpired over the next week. So for any of you interested in checking out Louis's blog that he has, it's smaugled.com, SMAULGLD.com. Check out his blog there. It's a great read. Louis, pleasure having you on as always.
Likewise.
Guys, if you have any questions or concerns, real estate needs, you can reach out to us at realestate360live.com. That's realestate360live.com. Take care, guys.